profitability does not equal cash flow. Sometimes cash flow is all about timing. And so when we take those three together, you can really put together that solid cash flow schedule that can help you manage your business.
Welcome to Real Estate Developer Discussions with Katie Kim. Today, we're kicking off something special with our brand new Beyond the Build series, because here's the truth. Building the project is only half the game. What really separates developers who thrive from those who just survive, understanding the money behind the mortar. And when it comes to untangling cash flow, tax strategy, and financial moves that can make or break a deal, there's one person I trust. It's a powerhouse joining me today, Cheryl Heller of Pillar One Consulting. Cheryl just doesn't balance books. She helps developers, investors, and business owners unlock the financial side of their vision. Today, we're talking cash flow, not the buzzword version, but the real in the trenches strategies that keep deals funded, your investors happy, and your projects moving forward. So grab your notebook, grab your coffee. This is Beyond the Build, because building wealth through development isn't just about what you construct. It's about how you manage the money behind it. If you caught the first session with Cheryl, you know we have a lot more knowledge that she's going to drop on us today. So Cheryl, welcome. So excited to have you back again.
Thank you, Katie. I'm excited to be back.
Awesome. And for those people who missed the first episode, which I know after this one, they're going to go back and watch because they're going to say, what did I miss the first time? Give those listeners a little bit of background and intro into who you are and what Pillar One Consulting does.
Yeah, so I started my career in financial services, spent about 25 years in large household names that you all would have heard. And then about 7.5 years ago, went out on my own and started working with small businesses and startups, and really sort of love that change into working with folks that are trying to sort of build their vision and get their companies off the ground, and really supporting that small business community. So for Pillar One, really what I do is provide fractional CFO and strategic advisory services for those small businesses and startups. Along the way, I also picked up a habit of real estate investing. And I focus
Love that habit.
mostly on short-term and midterm rentals.
Awesome. And I'm so excited to have you back today, because we're going to talk about one of my favorite words. I mean, grant is my favorite English language all the time, but cash flow. So we're just going to dig right in. You know, we don't have any fluff on this, like dig right in. Talk to us about cash flow. How do you go into that discussion, that mindset with your clients?
Right. So I look at cash flow in sort of three sections, right? There's operating cash flow, investing cash flow, and financing cash flow. So your operating cash flow is what you get from running your business on a day-to-day basis. Your revenue that you bring in, less your expenses that you pay out. Then you have your investing cash flow, and that's what it takes to invest in your business. So if you need to buy a new piece of equipment or something along those lines. And then financing cash flow is all of the stuff that we spend a lot of time talking about in real estate and real estate development. So that's your equity, your debt, your capital stack, all of those sorts of things. And all of that together is your overall cash flow. So you want to be looking at what's coming in from your day-to-day of your business, what are you paying out to invest in your business, and what are you getting in or paying out when you're raising money or getting a loan. And so when we take those three together, you can really put together that solid cash flow schedule that can help you manage your business.
So how do you take those three buckets? And I love how you broke that down, because I don't necessarily think people look at their budget or their P&L that way, right? And so I love the operating, this is what I need. And I think that's where people almost 100% focus their budget, their P&L, their strategy on, but then leveraging, or not leveraging, I should say, but bringing into play the investing and financing. And I know when people think investing, their minds switched here, and you brought it back this way. We're investing in more of the products and the services that they do. Whereas then the financing is how are we structuring, and now in this buy a business mentality and economy, I should say, it could be financing, somebody to purchase the business or out or expansion or. So let's take the first one. Okay. So stepping into operating, when a business is looking at expanding. And that's usually when, as we know, a lot of times they're going to want to bring somebody like you in. They should bring you in ahead of time and way before, and definitely before a big transition. But a lot of times we get brought in when it's the dire need, right? So you're kind of coming in and doing, open heart surgery on a beating heart in a sense. And so when you're looking at operating and that operating cash flow and they want to grow, what are some things you step into? What are some things you ask the business or you look for?
Yeah. So first thing that I want to say, and I talk about this a lot, profitability does not equal cash flow, right? So you
Oh,
might
say it again.
have
Say it again. Wait. Say it again. Say it again.
profitability does not equal cash flow.
Yes.
So you might have a business, your P&L might look great. Like you might have a net income in the positive. You might think you're doing wonderfully, but that doesn't necessarily mean you have the cash to pay your bills. So sometimes cash flow is all about timing, right? So you might send out an invoice for a big client job and you have to pay your payroll next week because your people are working on that job. But if your invoice isn't due for 30 days, you don't have that cash in the door. And so it's really this timing mismatch of when your cash is coming in the door and when your cash is going out the door. Whereas if you look at your P&L, you've got that revenue and your expenses line up nicely to that revenue. So it looks like you're, no problem. Everything's going great. So that's one of the things that I talk to my clients about is this sort of cash flow timing and what we can do to make it work for the business, right? Can they pay their suppliers in an extended time frame, right? Like when you're negotiating with your suppliers, you always want longer to pay them. Can you negotiate with your customers that they need to pay you sooner? So you pull in that time that you get the money in the door, and you extend the time that you have to pay the money out. So that's always really critical to think about when you're looking at your operating cash flow. And it might be things like, can you negotiate different terms with your suppliers? Like, can you get a discount if you pay early? And that would save you cash overall, even though your cash goes out the door earlier. So those are all the things around like operating cash flow that you might want to think about. Then when you go into investing cash flow, that's
I'm gonna tee you home for a second.
Sorry.
So no. So a couple of things that I find, and I got to dig into those before we go. But a lot of times I find, and I don't know if you do or not, but people think the P&L is their cash flow. So, and what I mean by that is I remember my dad, and he's a very simple man. He's just black and white, like, show me the money, like to take the rent checks to the bank himself, talk to the teller. And when he would get the P&L, he had very colorful words, of like, well, this isn't blah, blah, blah. And I'll, eliminate those explicits. But what he didn't understand, and I think it's hard because it is a profit and loss statement, right? But if you have a loan in your business, or if you have some kind of financing in the business, it's a very critical point for me to point out. And I always do this with my clients too, is that you may have the interest that you pay showing up. You should have the interest pay that you're showing up on that P&L. You don't have the principal portion of that payment.
Exactly.
And that I want to land with people because they're like, wait, what? Because my dad would always be like, well, that's not how much money we made this month. And I'm like, no, you got to take in the more. He's like, well, give me what I got at the end of the day. I'm like, oh, that's cash flow, right? Exactly. Like it's those different statements and it's the simple terminology. So I wanted to pause on that because I think a lot of people, when you see profit, like this is the profit. This should be what I take home. And it's not the accounting way we do profit, it's cash flow. And so then you might be saying, okay, so wait, I'm just looking at my P&L and balance statement right now. Okay, so let's introduce the cash flow statement, right? When you're talking about that, I love when you talk about terms because a lot of times people don't understand how those do affect your cash flow, especially when you're growing, right? Is it net due upon invoice? Is it 30 days? Do you have somebody that's not paying you? And then I want to go into the second thing, the second terminology I usually have to teach before we get to the investing, right? The second terminology I usually have to teach is talk to us about when you run these amazing reports in cash basis or accrual basis.
Yes. So that is specifically an accounting term, right? And I think depending on the size of your business and the type of business you have, you might want to pick accrual basis or a cash flow basis. But what a cash flow basis, that's the one that's easiest to understand.
Yeah.
If the cash comes into your bank account, you count it. If the cash leaves your bank account, you count it. And it doesn't like if you know that if you get an invoice that you know you're going to have to pay next month, you don't do anything with it because the cash is still in your bank account, right?
Yep.
And so, you still need to plan from a cash flow basis, right? Because you need to know next month what your cash is going to look like, because you have to pay that bill. But when you look at your P&L on a cash basis, it's not included in there.
Mm-mm.
So, but it still doesn't get to the point that you were making about your principal payments, right? They're still not in your cash basis P&L, right? They're still separate from
Accrual or cash basis. They're not in, they're just
right,
not in there, guys. It's just not in there.
right.
Yeah.
Then when you go to accrual basis, what the accrual basis, the point of that is to map the period of your revenue and your expenses. So,
Mm.
for example, if you perform a service for somebody this month, you count the revenue this month, even though they might not pay you until next month. And so your accountant, your bookkeeper will make a journal entry that they will put revenue on your income statement, and then they will put a receivable, your accounts receivable, on your balance sheet that says, we know we're going to get money from this client next month. So that's where the accrual basis comes in. And you do that both for revenue and expenses, right? If you know that you incurred a service this month, but you don't have to pay it until next month, then you would record the expense this month and record what's called an accounts payable on your balance sheet. And then next
Mm.
month, when you pay that, you don't touch your P&L. Your journal entry that your accountant does is simply between your cash account and your accounts payable on your balance sheet. And so that's where the difference between the accrual basis and the cash basis come in.
Awesome. And I didn't want to scroll out, but I want to definitely talk about that because I think when you look at your books, whether it's the P&L, the balance statement, or the cash flow, is really important to know what type of numbers you're looking at, or what I would say, like what system. I don't know, that's a bad way to say it, but like, am I looking at
Methodology.
yeah, methodology. Thank you. That's a great way. I do math, remember? So like cash basis in my mind is one in, one out. Like that's what's actually like a real-time play. This is what's happening in real time. The accrual is kind of a projection. We're hoping it is, where this, that is coming in the future. Like you said, we're booking it because we know it's coming, hopefully, but and it's coming back. And
So I would say it's less of a projection. It's more
Mhm.
of like we know it happened, but the cash just hasn't come into our bank account or left our bank account yet.
Yeah. Okay. So it's not in the game, right? It's not
Right.
in the, yeah.
So it's
Okay.
actual like what the accrual basis methodology is trying to match up your time period with your activity.
Yes.
Right.
And for our disclosure purposes, make sure you contact your own accountant and your own CPA or reach out to Cheryl to figure out which basis you should be on, because there are definitely tax benefits to each one, right? There's tax benefits to going a cash basis and accrual basis. And if you have a business, you are reporting on one of those bases. Like your
Right.
CPA will say, are we on a cash basis or accrual? If you do not know, ask the question, right?
Yes.
Get
And
informed and know.
well, and here's the thing too, like your books are either cash basis or accrual basis. Your tax return is also either on cash basis or accrual basis. And
Yeah.
so it's important to understand what's going on there, because what happens sometimes is if you're on accrual basis this year and you count, so let's say you count revenue that you received this year on accrual basis and you pay your
Mhm.
taxes on accrual basis and you don't
Yeah.
realize this. And next year, for some reason, your accountant decides to do a cash basis and you received that cash next year. You paid
Oh,
tax on it this year, you receive it next year. If you don't reconcile that, you might pay tax on it twice.
so if you're switching basis, or if your
If,
accountant doesn't tell you you're switching
yeah.
basis, you could be
So
paying taxes on twice. Oof,
yeah, so you have
that's
to pay
painful.
attention. You have to know which you're on for both your books and your tax return.
Yes. And if you switch, know the consequence and the intention. I
Hmm.
don't know if intentionality is a word, on it, both ways, because it could be a good strategy if there's a certain windfall coming or not coming, right? With
Well,
that.
I mean,
So
you're paying tax on it. You're going to pay tax on it sometime. You just don't want to pay tax on it twice, right?
yes, oh, 100%. I don't want to pay taxes once, much less twice.
Right.
But I do. Okay, so then let's go. I just want to slow down and speed up on that one because I want to make sure that everybody has that playing field. Because, like I said, when my dad would come in, he'd be like, "I just want to know what's in the bank, what's in my pocket at the end of the day," right? And a lot of, I think, business owners and investors want that, and you could have a false sense of security or a false sense of your cash flow if you're just looking at your P&L
Yes,
and with
absolutely.
debt in the company. Okay,
Mhm.
so now, okay, that's operating, and there's a lot more that we'll probably come back to with that. But now let's go to that second bucket you talked about, investing.
The investing cash flow. Yeah.
Yeah.
So this is, if you spent it for things like, purchasing an asset that's going to help you deliver in your business, like a piece of equipment, right?
Mm,
Or even, if you want to purchase some securities, like you have some extra money and you need to put it somewhere. So you're going to purchase some securities and, leverage it that way. But that's really for that sort of longer term view. That's not something that's happening in the day to day. That's sort of outside of the norm of the operating portion of your company. Then, if we move on to financing, this is where a lot of that activity then comes back. Exactly what you were saying about the principal payments, right? This is
mm,
where you're going to find like your principal payments, your interest payments, your dividends. Like if you have a company that has equity that you're paying out dividends to your shareholders, right? Your dividends are going to come through your financing cash flow. And
yes.
so when you look at your statement of cash flows, we have our P&L, our balance sheet, and then our statement of cash flows. You're going to have those three sections. The operating section is really where the bulk of the activity happens. The
Yeah.
investing and the financing sections are usually a lot smaller, but you need to remember them because that's also impacting your bottom line cash.
So with the investors that are growing their business, a lot of times we're not making any, net profit or anything. We're just keep putting the money in the business. How do you work with them to have that strategy of, I want to kind of say like stocking away the money to be able to invest and to finance? Because sometimes those business owners or developers are just like, I don't know if I have enough money to grow.
Yeah. So and I work with a lot of startups too. So startups
Mm,
could be pre-revenue or very low revenue for the cost of running the company, right? And so we're out there raising money from investors. So that all goes in that financing section, right? The
mhm.
inflow that we're seeing is coming
Yeah.
from the investment, not from the operating portion of the cash flow statement. And with the other tool that is really useful in addition to your cash flow statement is usually like a 13-week cash flow forecast, right? And
Mm.
so, and you could do it for longer too, but 13-week rolling cash flow forecast really helps you understand what your cash is looking like each week, so that you can understand the timing differences that we spoke about. Are you paying payroll this week and you're not getting the invoice from your client paid until next week? Do you have to pay raw materials? A lot of times, if you're in the
Mm.
manufacturing business, you have to buy your raw materials well in advance of when your product is delivered because not only do you have to have them to make your product, but there might be lead times on getting the raw materials in your factory, right? So,
Oh, yes.
that's something that you have to be really careful about. And you can finance things like receivables, right? And so you can get money in the door earlier and have the bank lend to you based on the promise of those receivables.
Oh, talk to me
Down
about
the road.
that. Like that's yeah, and then I gotta go back to this to the inventory. But yes, like
Yeah. So
finance on receivables.
yeah, and this and there's going to be a whole lot of underwriting similar to when the bank is underwriting a mortgage for you because they want to make sure that those receivables actually are real receivables and that they're going to
Mm,
come through. But
yeah.
that could be a situation where if you are constantly churning through and you need money, working capital to buy your inventory, and that people have said that they're going to buy from you, you have receivables out there because you have contracts, right, are ready to produce that
Yes.
those products. You can go to the bank, bring those contracts, and get receivables financing.
That's amazing. I love that. I
Yeah.
haven't done that one yet. I'm excited about that opportunity. Now you put that bug in my head. So, because I think about when we did the bakery project, and a lot of times when banks or other institutions that you're getting financing from, right, is they want the last 2 to 3 years P&L, bank statement, and then they usually want like an up-to-date P&L or an up-to-date cash flow basis. Like, where are you at right now? Like, was this great the last 2 years and now you're tanking, or are you like doubling? And what we had to do was really put a narrative with the finances. And we have to do this often for, I would say, inventory heavy businesses that are expanding. That's a big sentence there. But because, for example, I'll never forget the pecan example. So with the bakery, there was a situation in California where most of the pecans come from, and they had an opportunity to buy ahead of the price spike. And so they had to buy as well as some flowers, similar situation, and store that. Well, that was going to be like 3 months of product. I mean, maybe not so much on the pecans, but it was going to be months of product that they were going to use, that then when you go to their P&L or you go to like look at their finances and in like that snapshot, and I want to say that snapshot of time, it looks horrible. I mean, and it was like the bank, I mean, we called like multiple meetings coming in, let's talk about this. And it was simple when Jeff was like, well, here's what happened, and we're going to use this product. So now you're not going to have this cost of goods for the next, 6 months or whatever it was, because they were almost on like a less than 30-day net. Whatever they bought in, they went out the door. It was pretty quick. So buying in bulk in that fashion was out of their business practice. It sent a red flag. And so one way that we did in that situation, because again, we were financing a bigger project for them to grow, was to put a narrative with those financials to be able to explain them to those underwriters or banks. So I would assume in that same going with receivables, there may be a narrative that comes along with it.
Absolutely. And so interestingly, like for the situation that you described, I would have expected that it would have just been raw materials on their balance sheet, that it wouldn't have flown through their cost of goods until they actually used it to produce the bakeries or produce the baked goods that they were making. So, it could go either way, right? You could have a non-P&L impact, and all of a sudden your raw materials inventory looks so high on your balance sheet, and the bank's like, well, what's going on here? You're stockpiling something, like why? And then, you'd still have to have the explanation because your cash is down and your inventory is up, right?
Absolutely.
But I think the narrative, like bankers that I've worked with are always looking for the narrative. They're looking for the story, even if it seems like a simple, very straightforward set of financials. It's always helpful to have that story about what you're going to do with it. Take your vision. We talked last time a lot about the vision of the company or the vision of the entrepreneur. Like, what are you trying to do? And, the bankers are so educated in all of the different ways that they can help you, that if they understand your vision, you might be going in thinking, oh, just give me a loan for this. And they understand your vision. They're like, actually, what if we did this over here and then put it with this? And then you would have, and you're like, oh, I didn't even think of that. So I think the more you can really share that, the story, the vision with the people that are helping you, like that's going to, make a big impact as well.
Amen on that one. It makes me think immediately of a very recent conversation I had with one of my development partners, Mike, and our banker, Tom, who I know is going to be watching this episode. So shout out to Tom. And we came to him saying, we need this for the development. This is what we're going to do. Some tenant fit out and some other things. And he came back to us and said, well, why don't we do it in this way? And Mike and I are really savvy. I'm going to say pretty savvy. I'm going to say really savvy with that. And we're like, oh, that's good. And it goes back to why I stress to all my students in the academy, like build your network and build it constantly, because especially I think in this time frame, in this economy, we are constantly coming out with new things, new programs. I mean, I'm super excited to dig more into the opportunity zone enhancements that are in the big, beautiful bill that I don't feel like anybody's talking about, except the big thing is the depreciation, right? Like that's everybody's talking about that. And we can get to that in a minute. But like from the cash flow standpoint, I think, and I'm bridging business and real estate development here too, because as you go for those financing, I think on the real estate development side, it's easier to say, this is the story, right? This is what we're producing. We're taking this raw land, we're building this building, we're going to have these tenants, we may be building our business into there, but you almost, I feel, you need a separate narrative for the business growth and how that's going to get there. And the more you can have that narrative outlined and have that narrative ready to go with the documents helps your team. And I'm going to say your team because your banker is not just a transactional thing. It should be a relationship and grow with them and let them leverage their mind. Like one of the things I tell my team, if I'm not listening to what you're saying, if I'm not challenging your thinking, I'm burning money because I hired you for your mind. I didn't hire you to transact, right? Like now we have AI, we have all these automations. That's great. I want your brain on it. And so when you step into that narrative, what are some key things that you think like, tell this story, guys? I know you don't want to tell it, but tell this story, or what are those key parts that you think we should have in our narratives when we're submitting them?
Yeah, so I think that sort of mission vision is critical. And I think, if I think about, I've worked with a lot of startups on their pitch decks, right? And so we're kind of like constructing that story. So what is the problem that you're trying to solve?
Yeah.
And why now? Like, why is now the right time to solve that problem? And why you? Why are you the right person or the right team to solve that problem? And really pulling all of those pieces together, I think helps create this sort of like, well, of course I'm going to support you because all of these things kind of line up.
I love that. So those three questions are, what problem are you solving?
Mm-hmm.
Why you, or why now? First is why
now?
now, and then why you, or why this product and solution.
Mm-hmm.
I love that. I think that's great because that hits the nail on the head, right? Of if your business is expanding, what problem are you solving? Or are you already solving that problem and now you need to grow, right?
Yeah.
And you've proved your concept and you're growing out. So when you look at startups and you mentioned that you work with a lot of them and you kind of work with both ends, right? You work with the startups and then you work with the mega companies. What's the big difference on how they look at cash flow? Or is there?
I think so. Cash flow looks at it startups look at cash flow in terms of runway. How many
Runway.
months do they have until they're going to run out of money? Right?
Yep.
You raise $1 million, your run rate is $100,000 a month, you've got 10 months. And that will sort of inform like, okay, so in month 5 or 6, you probably need to go out and raise more money, right? Because you're going to run out of money soon. And so really like, what's that runway? How long is it going to take you? Whereas more established businesses really don't have that runway mentality because they're constantly bringing in let's hope they're constantly bringing in revenue, right? They're covering their expenses. And so really then it's how much excess do they have for their growth?
Okay. I like that. I like that difference in the mindset. So now I want to take all things cash flow. And last thing I think we're going to hit about before we go is development, right? So when I put together performance projections and that they're just that, right? They're a guesstimate at the best case scenario with the given information you have at the time, right? When you look at that, there is a cash flow aspect to the development in that construction timeframe. And there's also then that transition from done with the development going into the cash flow for, let's call it ramp up of stability or the stabilization period, right? Before it truly gets everything done. And I don't want to say is on the path, you always are tweaking a development, I think. But talk to me about when you're looking at that construction time frame, how do you go into estimating and like kind of saying you're going to need this much, as you said, runway money, you're going to need this much financing? Because when I look at your like 3 buckets on that development side, when you're in construction, I feel like operating is the construction cost, like, right? That's what you're using to operate that development and build the building or enhance the building. Your investing is getting that equipment that you need in for your business into that. And then that financing is the cost, right, of doing that project and that runway money to launch. But how do you look at it in that way? Or is it like, how would you look at it and then put those numbers together?
Yeah, no, I think it makes sense to break it out into that those buckets. I think the one thing that I would say is if you're a developer and you're doing the development costs are your operating costs. But if you're a
Mm,
business, for example, your bakery project, right, their operating costs are running their bakery. That
yes.
development cost is going to fall into the investing cash flow, right? Because they're investing in the long term of their business. And so that's
Yes.
just a slight tweak in how I would think about it.
Okay.
And I think, we've talked about, maybe it was in our last conversation about the data, right? Like you want the
Oh,
data to
yes.
support where you're going, but particularly with development and how long it takes, and then your stabilization period, what I would say is that you always have to assume it will take you longer and cost you more, right?
Amen.
Have to have that buffer. Um, because and if you get to the point and it's on time and on budget, like great, you have a huge win. But
Yeah.
the bad situation would be that you did not project a buffer or for either time or dollars, and you get to the end of the project and you can't finish it because you don't have any cash left.
Oh,
Right.
yeah.
So you always have to assume it's going to take you longer and cost you more.
Yeah, and there are many ways that I'm sure we'll even go into more on this podcast of ways to control the construction, control those costs, plan for it, risk mitigation plans. Like we have a lot of ways we go into those construction projects. But at the end of the day, to me, I usually go in my budgets with three contingency buckets for exactly that. Like there's a contingency bucket on the construction, there's a contingency bucket on the finance, and there's a contingency bucket on the stabilization. And I don't share those with people. I mean, I share them with the bank and obviously the draws, but like when a lot of times when people see money, they like to spend it. So if they
Mhm.
don't see the money and we have like the draw for the construction schedule and then you have the overall project budget over here, that helps people stay within those spending limits. So you kind of like keep them in their zone. And people think differently when they don't think there's an endless checkbook, right? When they think like I got to get creative with these ideas and I think that's all part of those three buckets that you mentioned, the operating, investing, and financing.
Yeah, I
Yeah.
think that's so important. And the other thing that I would say is when I'm working with businesses and just looking at their general operating forecast, right? I'll
Yeah.
generally do three forecasts, right? You have your base case, which is with all the best guessing, that's what you think is going to happen. And
Yep.
then you have your best case scenario. So if everything hits, if everything goes in your direction, what could that look like? And then worst case. What if all of the things that you think might go wrong go wrong? What is that
Yeah.
worst case scenario? And then you have that, at least you've had that thought process. And so you can
Yeah.
plan and pivot when you need to, midstream, because you know what are the levers and changes that you would make, like in that worst case scenario. If that started to happen, what are the levers that you're going to pull so that it doesn't completely tank your year? Right? And in the best case scenario,
Yeah.
if things start going well, what are the levers that you want to pull to take advantage of that? So
Yeah.
having those kind of the three buckets really, I think, works for a lot of different reasons.
I love that because it makes me think of when I do projections to go into a pitch deck, right? I probably have three versions of those same projections. And not that it's different, it's exactly that. It's okay, our occupancy is 90%, our occupancy is 50%, our occupancy is, and you kind of look at that like, okay, where is that break even point? Where is that point that at the end of construction, we have got to be here to start breaking even, or we're starting to tap into that financing bucket and we're going to
Mhm.
have to subsidize it till we are stabilized. And again, what's that runway money? So whether it's business or development, right? Because that would be, the business of developing is those buckets. And I like how you do that. I want to make sure lights can stay on at the end of the day, or what needs to happen if that needs to be subsidized, right? What are we looking at? Nobody wants to hear capital calls. I get that. Sometimes they happen. What does it look like? How much do we need? Why and for how long? And when you start to communicate those with your investors, with your investor group or ownership group, it's okay. Then we go to looking at the cash flow to drive what's the strategy. What do we have? Like we have 4 months of runway. Okay, what are we doing to double down, increase sales, whatever it is, get more money coming in the funnel in that 4 month time frame? Whether it's a development, whether it's a business, on that same side. Love it. Love it. Awesome. Well, I know we probably could dive into way more things on the cash flow. So if you are listening to this and did not get the first episode with Cheryl, please go back, check it out. Hit a like in the comments and make sure you subscribe so you can hear more, because we're going to have more of Cheryl coming on with our Beyond the Build series as we start to look at those numbers, not only for the development side, but for those businesses that are looking to also expand with development and have generational wealth in the real estate as well as their business. And so, Cheryl, greatly appreciate your time today. Thank you. It's always a pleasure. And we could always talk for like 5 more hours. But we have to come to close. And if people are looking to engage with you, and I want to take a step pause as you tell us this, because I love the 3 different ways that you engage with your clients. So tell us a little bit about those 3 ways, and then tell us where our listeners can find you.
Yeah, of course. So the first level is the CFO in a box, and that is a set of accounting policies and SOPs, sort of a do-it-yourself for folks that aren't ready to hire a CFO. And then the middle level is a set of monthly reports that we can work with your bookkeeper to pull so that you can see your financials in a more visual way. And then the third is really working with me and the team on fractional CFO and strategic advisory.
That's when they get the full force, Cheryl. Love it.
Yes.
And where can they find more information about you and Pillar One Consulting?
Yeah, so on social media, it's Cheryl A. Heller on Instagram and LinkedIn. And you can reach me at Cheryl at Pillar One CFO, PILLARONE.
Awesome. Awesome. Well, and we will also put those in our show notes and the comments below for you guys if you want to connect with her. Easy way to find it. So definitely make sure you hit subscribe so you're aware of any new episode that we come out with, because we are looking to come out with 1 a week, and we really want to focus on real raw discussions and really give you those insight and that seat at the table for those real estate developer discussions that you may not be a part of, but you definitely want to hear all the juicy stories, scars, and strategies behind everything. So thank you for joining us today. We'll see you soon. Let's go. Hey friend, before you go, I want to say this. If real estate development has been on your heart or on your mind, we've built lanes to help you walk it out wherever you're starting from. Just exploring? Start out with our free live masterclass. Ready to do the reps and build the strategy? Join the Developer 101 Bootcamp. Already active and need to level up? Step into the Real Estate Development Academy. You don't have to figure this out alone. We can teach you, we guide you, and we walk with you. So head over to katiekim.com and book a call with our team today, and let's figure out the best first or next step for you. You're not behind, you're not too late, and you're definitely not too early. You're right on time. Let's go. The information in this podcast is for educational and informational purposes only. It is not legal advice. It's not financial advice. It's not investment advice. Real estate development, like any investment, carries risk. Before you make decisions, you should always consult a licensed professional, your attorney, your CPA, or your financial advisor, to name a few, to make sure you're making the right choice for your situation. I'm here to share insights and strategy, but you're responsible for your own decisions, and each situation is unique. So make sure you contact your professional team to give you your specific guidance for your specific case, as each real estate development's different and unique and has its own challenges and opportunities.